have some exercise time again. Okay. So, so far we've talked about the concepts of fixed income securities, mostly bonds, okay? And then we talked about how to calculate the value and so on, how to read the bond table. And at the end of last class, we talked about government security, treasury bills, and so on, okay? All right, so talking about fixed income securities, obviously we are talking about long-term debt, okay? I think I mentioned it a few times already. When a corporation needs to raise some capital, additional capital, they basically have two ways, okay? The equity financing versus debt financing, okay? So here, before we go on, let's talk about what are the advantages and disadvantages of debt financing, okay? Well, advantages are low cost, okay? It is less expensive than equity financing, okay? Because interest costs are tax deductible. Okay. So what that means is when you issue the bond, you make interest payment every 6 months, okay? And you can deduct that interest payment from your profit, which will reduce your income tax liability, okay? On the other hand, if you pay dividend, if you raise the capital through equity financing by selling, stocks, okay? And if you pay dividend payments are not tax deductible, okay? It does not reduce your tax liability, okay? So that's why it is inexpensive or low cost. Debt financing is low cost relatively, okay? And leverage increases EPS. We talked about this when we were dealing with DuPont analysis, okay? What is it? You can increase the return to equity, ROE, by increasing your leverage, okay? And the earnings can be, another thing we should remember here is earnings can be increased without dilution. Well, since we didn't talk about stocks yet, I guess we didn't really formally talk about dilution, okay? But I think many of you understand it already, right? When you issue additional stocks, that reduces the total number of shares outstanding, okay? So for the same amount of earnings or EAT, when you divide it by number of shares outstanding, okay? For the same amount of EAT, when you issue more shares, that reduces EPS, okay? That is called the dilution. Dilution means that you add some water to any liquid, okay? Add water to makgeolli. Do they still say that? 야, 손님 취했다, 물 타라. Yeah. All right. So that's the idea of dilution. Okay. So when you raise capital by issuing bond rather than stocks, right, you can avoid dilution. Okay. All right. And then also, because you prevent issuing more stocks, okay, by raising capital by bond, current owners maintain control, okay? You are not creating more owners, okay? Okay, disadvantages, of course, when you borrow more and more money, it increases financial risk. It increases your financial obligation, the interest payments, right? So when the economy slows down, and if your sales slows down, the times interest earned, okay, can go down, okay, and it can be a burden. The interest payments can be increased burden on the company. Okay. And then when the company has a lot of debt, you will face a lot of restriction by lenders. Well, you may already have some restrictions when you issue the existing bonds. Okay? But in case you try to borrow more money, okay, then banks and investors will require to satisfy a lot more stringent conditions, okay? Because they don't want to put their existing investment in jeopardy. Okay? All right, so make sure you understand the advantages and disadvantages of long-term debt financing. All right, now we are formally going to talk about valuation of this debt asset or fixed income security. But as you know, pretty much talked about it already. Okay? So the value of a bond is based on expected future benefits over the life of asset. What are the future benefits? Well, nothing but cash flows. Okay? And when you issue a bond that today, okay, and let's say 10-year bond, okay, every period, either every year or every 6 months, there will be cash flow, which is interest payment. Okay? So you have to discount all these cash flows to calculate the present value or value of an asset, of this asset. At the end, in the end, when the maturity comes, okay, in addition to the interest payment, there will be also a par or the repayments of the principal. Okay? So that has to be discounted also, right? So the principal or the essence of value of an asset is simply the present value of future benefit or future cash flows. Okay? All right, so as we've seen before, we've used this formula to discount future cash flows, and that's how we calculate the current value. Okay? One thing here about this interest rate. Okay? Interest rate is discount rate because we use that interest rate to discount the future value of the future cash flow to arrive to the present value. Okay? But I think I made a general comment that discount rate should be equal to the market interest rate, right? Because market interest rate is basically the opportunity cost of time. Okay? If you have certain amount of money, you have alternatives. Okay? Either you can buy this bond, or you can put your money to some other uses. Okay? You can buy stocks, or you can put it in the bank, or you can lend it to your friend, whatever. There are many alternatives, right? So what is the opportunity cost of your money? Okay? What interest rate should you expect from whatever particular investment you're trying to make, right? This particular bond. Okay? So that's the concept of market interest rate. Okay? Well, that's the general comment. Okay? But depending on the nature of particular investment, okay? If you are investing in a little more risky stock or risky bond, okay? Let's say junk bond, okay? Then you should obviously require a little higher interest rate because you are putting your money at risk. Okay? So when you decide what interest rate you're going to use for this discount rate, okay? The general rule is market interest rate, because if you use your money for other purposes, you can earn at least as much as market interest rate. Okay? But if you know this particular bond is from a company which is a little riskier, okay, doing some risky business, okay, then you should increase the discount rate. Okay? All right. Chapter 8 is about the risk, and at that time we'll talk about more details about how to determine cost of capital or the rate of interest considering the risk level. Okay. All right, so here's a very formal statement of the value of bond or cash flows from the bond. Okay. So you've seen this before. I is for interest payment. Same thing as cash flows here. Okay. And depending on the maturity of the bond, the number of periods goes from 1 to n. Okay. And KD is discount rate. Unfortunately, we use many different notation for this rate. We use KD, we use I, in some other notations, textbooks, we use R, right? But as long as you understand the concept, I think you can make it out, right? So KD here in this formula is nothing but discount rate, okay? Or cost of capital. Okay? All right, so you discount all those individual cash flows by the number of periods, okay, and make summation like this, add them up, okay, and then at the end of the life of the bond, there is maturity payment. I guess M stands for maturity payment, or you can say par value of the bond, okay, or principal payment, okay, and you discount it for just once, okay, for n period, okay? That's the number of periods in the maturity. Okay? So you can rewrite this in this way, just bring I outside here, M outside here, okay? And then these numbers become nothing but PVIFA and PBIF, okay? Present value interest factor of annuity for number of periods and the corresponding interest rate. And here this is present value of interest factor, okay? So the first one is for annuity, second one is for just single lump sum value, okay? You know what we're doing, okay? All right, so that's how you calculate the present value of a bond, okay? In reality, though, it is a general practice that bonds pay interest twice a year, okay? Every 6 months, right? So if you have, let's say, 20-year bond and say 8% coupon rate, right? Then you cannot, if you use the previous formula like this and use 20 for N and 8% for KD, right? Your calculation will not be exact, very accurate, perfectly accurate. Right? So in order to reflect that reality, we can slightly change the formula. Okay? So instead of using I, or annual coupon payment, we can divide it by 2 to make it semi-annual coupon payment. So instead of $80, we're going to use $40, okay? In my previous example. Okay? And instead of 20 for N, well, I guess we can multiply N by 2, because you're going to be receiving coupon payments 40 times if it's a 20-year bond, twice a year, okay? All right. And then you also have to divide the annual percentage interest rate by 2, okay, to make it semi-annual interest rate, okay? So that's it. That's, as long as you do that, you can calculate, I think you understand exactly what we are doing here, okay? So here, again, when you discount the last principal payment, instead of 20, you're going to be using 40, 2 times N, okay? And 8% divided by 2, like in that example, okay? All right, so that's going to be more accurate formula for semi-annual coupon payment or bond value. All right, want to do some exercise? Let's say Suppose you invest in a bond with a coupon payment of 60, or in most of the problems you would say coupon rate of 6% and par value of 1,000 and maturity is 10-year bond or note. Okay? 10-year, say, corporate bond. Okay? And let's say current interest rate is 6% also. All right? Can you calculate the present value of this bond? Okay? See if you can do that quickly. So if the coupon rate is 6%, what is the coupon payment, annual coupon payment? $60, okay? You should be able to do it very quickly, right? You can do either way. You can use PVIF formula or you can use calculator. Okay? Well, first time just think this is the one payment per year. Annual payment instead of semi-annual payment. Right? Then present value should be $60, which is interest payment, the coupon payment, times PVIFA, 6%, 10 years, okay? Plus $1,000 times PVIF, 6%, 10 years. Okay? So you should be able to find these numbers from the table, okay? And calculate the present value. Okay? Or if you want to use calculator, make sure you clear the register first. Okay? And use $1,000. $1,000 for what? Future value, okay. And what else? 10 for number of periods. 6 for, well, 60 for what? Payment, okay. And then 6 for discount rate, interest rate, okay. And then press PV. What does that mean? Negative $1,000. We calculated present value, right? Present value comes out to be exactly $1,000, right? Does it make sense? All right. Because you are receiving exactly $60 every year, which means your coupon rate is 6%. Your annual return is 6%, right? And then you are discounting the entire cash stream using 6% required rate of return or discount rate, right? So your future value, which is 1,000, will be exactly the present value 1,000. Okay? Right? make sure you get this idea. You have to understand this intuitively, right? If your required rate of return is 6%, if you require 6% from your investment, right? That's why you would use 6% discount rate, right? And then this whatever investment you made here, it returns exactly 6% every year, right? And no matter how many years later, it pays you $1,000 back, right? Then the present value of this investment to you is exactly $1,000, okay? Right. How about changing it to 8%? Just keep everything the same, but this time discount rate is 8%. In other words, you are expecting 8% return from this investment because market interest rate is 8%. In other words, if you invest in otherwise, in other alternatives, okay, you can get 8% return, right? So you would use 8% for discount rate, right? Then you have to use 8 here and 8 here. If you use calculator, you can keep everything the same. You don't have to clear the register. Just re-enter the interest rate, 8%, and press present value. Hey, 865.80. Okay? So this time 865.80. Much smaller than $1,000. Can you explain this idea? Why is it so smaller than 1,000? What your return is what? Less than what you require, what you expected. Right? Right. So if you are requiring 8% return in your investment, then this particular investment, which pays 6% interest every year, is worth less to you, right, than the face value. Face value is $1,000. Par value is $1,000. Okay? Make sure you understand this relationship. Okay? So when the interest rate goes up, your discount rate goes up, then the present value goes down, or that particular investment is worth less to you. Okay? If you're requiring low interest rates, say 4%, right, you will be satisfied if you can get 4% return on your money, right? Then the present value of this cash stream will be much higher than $1,000, right? Just for the fun of it, you can try again, right? 4% interest, present value, $1,162, okay? Because your expectation or your requirement is only 4%, but this cash stream gives you 6% return on your investment, right? So for this particular bond, which promises you $1,000 10 years later, right? You can actually invest $1,162.22, okay, at this point. It is worth that much to you because you are earning 6% return every year. Okay? Make sure you understand this relationship, right? That's very important. That's a very important understanding as far as bond goes, bond valuation goes. Okay? Well, if you want, you can convert this into 2-year. Okay? Let's say annual coupon payment is still $60, but you're requiring 8%. Your discount rate is 8%, right? Then you need to change something here, right? So payment should be 60 divided by 2, right? Which is 30 payment, okay? And number of periods should be 20, okay? And how about interest rate? 4%, right? You have to divide 8% by 2 and put 4% as interest, okay? And then just solve it. Well, future value is still $1,000, okay? So solve it for present value. Was it same as before?
No. It has 100.
What was it previous? 865 something, right? Yeah. So then we have slight difference here, right? When you do semi-annual, okay? All right. So you can do that in case you want to calculate the value of semi-annual payments, okay? Okay. Let's go on. I think. All right. So here are a few points we have to remember. There's an inverse relationship between price, in other words, present value, and interest rate. We just talked about it. Okay. So next slide gives you this graph. Okay. We have inversely sloped or negatively sloped graphs. This blue curve and green curve, right? Blue curve, well, two curves are exactly the same except for the maturity. This is a 3-year 6% coupon bond. This is a 15-year 6% coupon bond. Okay? So for now, forget about 15%. Just think about 3%. Forget about 15-year. Just focus on 3-year bond. Okay? And we have this downward sloping curve, right? Which means if your required rate of return was only 4%, right? Then the value of the bond would be above $1,000. Okay? This is the value of the bond. Okay? First of all, here, if your required rate of return is exactly 6%, which is coupon rate, right? Then we saw that the present value of the bond is exactly 1,000, same as your par value. Okay? But if the required rate of return was below the coupon rate, then the bond is worth more than $1,000, worth more than par value. Okay? If your required rate of return is greater than coupon rate, right, then the value of the bond is less than par value. Okay, we just saw that. Okay? So this downward sloping or negative sloped curve tells us that inverse relationship. The second one is the effect of rate changes on long-term versus short-term bonds. Okay? There we need to compare these two bonds. Okay? Between the blue curve and green curve has a lot steeper slope. Okay? In other words, starting from about 6%, if the interest rate was 6%, exactly same as the coupon rate, then everything is at 1,000, right? Whether you're talking about 3-year bond or 15-year bond, present value is all 1,000, right? But suppose interest rate goes up to 7%. Then both bonds lose value, but the loss of value in 3-year bond will be much smaller than the loss of value in 15-year bond. Okay? In other words, longer-term bonds will lose the value a lot more than shorter-term bond. Think about why. Why would that happen? Does it make sense? It should make sense if you think about it. Just a few seconds. Right? Think about this timeline. Present value is what? Discounted value of future cash stream. Okay? And we're talking about the difference between 6% and 7%. Whether you use 6% to discount the future cash stream or 7% to discount the cash stream, right? Well, of course, in the case of 7%, you know that the bond value will go down, right? Present value will decrease when the interest rate goes up. But the thing we are talking about here is depending on the maturity, whether you're talking about 3-year bond or 15-year bond, right? In the case of 15-year bond, decline in the present value will be much bigger. Okay? Why? Why does that happen? What? What did you say? Well, yes, if the interest rate goes up, then we know that present value goes down, right? But what I'm asking is, depending on why does the maturity matter?
Because it affects the accumulation, how much accumulation you have. So
right.
If you accumulate more, then you have more big difference.
Right. So if the interest rate goes up, we are discounting these cash flows using higher discount rate, right? But if you're talking about short-term bond, like 3-year bond, right? Then that difference will be minimal because we have only 3 cash flows, okay? But if you're talking about 15 cash flows, right? Then the difference will accumulate, as you say, right? So the effect of higher interest rate will be much bigger on longer-term bond compared to the shorter-term bond, right? So that's why we have this green curve, which is a lot steeper than blue curve, right? For whatever in the opposite case, if the interest rate goes down, right? If the interest rate goes down, then we know the present value of bond will increase, right? But the amount of increase in present value will be smaller if you're dealing with shorter-term bond, right? But the amount of increase in present value will be much bigger, right? If you're talking about longer-term bond, okay? Basically, you have more period, longer years to reap the benefit, right? If you're holding longer-term bond, right? That's what this story is about, right? So effect of rate changes on long-term versus short-term bond, you have to understand that. Interest rate risk. There is an interest rate risk in holding bond, okay? Because as we know already, when the interest rate goes up, the present value of bond goes down, right? So if you look at any financial newspaper, Wall Street Journal or Financial Times, okay? Sometimes you see these charts, okay? Interest rate, price of bond, okay? If interest rate goes like this over the period, bond price goes like this, right? There is an opposite relationship, right, between, or upside down relationship between interest rate chart and bond price chart, okay? So when the interest rate goes up, price of bond goes down, okay? So let's say sometimes, bond investors hardly hold it until maturity. Nobody invests in bonds looking for the final payment, okay? Bond traders are just like stock traders. You know the principle, right? You buy low and sell high, okay? Buy low, sell high. That's the rule of investment or any trading, right? So bond investors, they look at the bond price. Who determines the bond price? Did you say interest rate? Yes, interest rate affects the bond price, okay? But market, yes. Demand and supply, right? Price of bond and quantity of bond, okay? So whatever specific bond this may be Goldman Sachs 20-year bond, okay? For some reason, demand goes up, then the price rises, Demand goes down, price goes down, right? So bond prices just, behave just like stock investors, right? Buy low and sell high, right? So, and also when the interest rate goes up, price goes down, but sometimes you have to sell at low price. Maybe you need some money, or maybe you have better opportunity, right? Something happened in Apple case, Apple bonds or Apple stock, right? Whatever, right? And you want to sell this Goldman Sachs bond and use that money to buy Apple stock, whatever, right? So in case you sell the bond at lower than maturity, right? Suppose the par value, right? Suppose you sold the stock at $900, right? Then return to the investor the rate of return to the investor will be lower than the yield to maturity. Make sure you understand that. Right? See if I can put it down exactly. If the bond is sold before maturity at a price lower than $M, which is par value, okay, then yield will be less than KD. Whatever the required rate of return you used to calculate the present value. Okay. That's the idea of interest rate risk. So rate of return, your yield to maturity, depends on the actual selling price. So in case yield to maturity, I think we talked about the concept last class, right? We're going to talk about it in a few seconds here, right? But the idea of yield to maturity is the rate of return the investor earns if you hold it until maturity, right? So if you hold it until the maturity, you receive $1,000 par value, then you can expect yield to maturity, right? But if you sell it before the maturity at a price below the maturity payment, right? Then yield will be lower than market interest rate or your required rate of return. Okay? That's the idea of interest rate risk. Okay? Reinvestment risk. If the interest rate, I should say, if the market interest rate is low when the bond matures or called. Bond is called. If the market interest rate is low when the bond matures or is called, okay, the fund the fund has to be invested at a lower rate of return. That's the idea of reinvestment rate risk. It's kind of obvious concept, right? When the bond is matured, right? So you receive your principal back, or sometimes bond is called before the maturity, right? Which means you have to redeem your bond, okay? Then what are you going to do with the money, right? You have to reinvest the money, right? But unfortunately, if the market interest rate is low at that time, right, then you're going to be forced to reinvest that money at low interest rate, right? That's the idea of reinvestment rate risk. I guess what the textbook is pointing out is that this is unique to fixed term security, right? If you are holding a stock, then you don't have, stock doesn't have maturity, and stock can be called, right? So you don't have reinvestment risk in equity investing, right? But this reinvestment risk is unique to bond or fixed term investment security. Yeah. All right, is that okay, or am I confusing you too much? All right. I think you understand this graph. So first of all, you have to understand why there is negative slope between interest rate and value of bond, okay? And then why there's a difference in slope, right? The longer term bond had steeper slope than the shorter term bond. Okay? That's what the graph is about. All right, yield to maturity, and we talked about it already, but we have the same formula, typical formula for bond, right? Discounting coupon payments for interest and discounting principal payment. Okay? If the price is known, so far we use this formula to calculate the present value of the bond, right? But if the price is known, right, and if a coupon and maturity payment are known, right, we can solve this equation for KD, right? And that's the yield to maturity. In other words, if you invested $900 here, okay, and you receive $60 every period and $1,000 at the end, and let's say that's 10-year bond, right? Then you can calculate your the rate of return you are receiving on that investment, right? And as I said, it's going to be quite involved. Okay? This calculation, if you want to do it by hand, right? It's going to take a long time and a lot of iteration. So highly recommend you to use financial calculator. Okay? Okay, so YTM, yield to maturity, makes the present value of the promised cash flow equal to the market price of the bond. Yeah, the same thing here, right? So making the left-hand side equal to the right-hand side. Okay? That's what the yield to maturity is about. Okay? So why don't you try that on your calculator using the previous example. Suppose the coupon rate is 60, coupon payment is $60, and let's say 10-year bond, and you just paid $900 for this bond. Can you do that? Calculate yield to maturity. Par value is 1,000. Yeah. So use the par value of 1,000. 1,000. Yeah, I know. Use that future value. Okay. And 60 as the payment, and 10 for number of period, okay? And what? Let's say 900 for what? Yes, you have to change the sign here. If you do 900 positive, just for fun of it, let's see what happens. Okay? So let's put it 900 as a present value and solve for interest rate. It says error. You can't do that. Right? If you want future payments of $60 and $1,000, you have to invest now. Right? You can't get 900 now and do whatever. Right? So let's say 900. Oops. Go back. 900. Change sign. Okay. P. Let's see if it works. Okay. Good. Right. And then solve it for interest rate. 7.45%. Right. That's the yield to maturity. Okay. All right, so you know how to calculate yield to maturity. All right. Perpetuity or perpetual bond, which means this bond never pays back its principal. It just pays the coupon payment forever, right? And we already discussed it previously, right, when we were dealing with the annuity formula, right, in the previous chapter. It's simply the payment divided by interest rate, right? That's the present value of perpetuity, okay? So if you have what's the yield to maturity of perpetual bond? Well, from this relationship, you can calculate KD is I divided by P0. Simple as that. Okay? PS stands for preferred stock. Okay? So preferred stock is the same thing as perpetuity because there is no maturity, right? So it never pays back the principal. So it ideally and theoretically, you should be able to receive the dividend, the set amount of dividend. It's a little weird because we didn't talk about stock yet. Stock is a concept of, the topic of next chapter, right? But the common stock dividends are not guaranteed, okay? Company can decide how much to pay quarterly dividend every quarter, right? And many times they decide not to pay the dividend at all, right? But preferred stock, when they issue preferred stock, just like bond, they have to state exactly how much dividend they're going to pay every period, right? So just like bond, for all practical purposes, preferred stocks are considered debt. It's not considered equity by investors, okay? Just like bond, okay? So here are some specifics of preferred stock, okay? It's an intermediate position between common stock and long-term debt. It is a part of equity, but it increases financial leverage. Formally, it is equity, but for all practical purpose, as I said, right? By financial analyst, when you analyze companies' worth or liability and so on, just like what you did in your project, right? Preferred stocks many times are considered debt rather than equity, okay? Because companies have obligation on this preferred stocks, okay? Dividends on preferred stocks are not tax deductible, okay? And it has priority over common stock with regard to earnings and assets, okay? So before you pay any dividend on common stock, you have to pay dividend on preferred stock. If the situation doesn't allow the company to pay preferred, they have no money, right? They can skip payments on preferred dividend, right? But that accumulates, right? Unlike common stock companies have no obligation to pay, right? So if you miss 10 periods, 10 quarters, that's fine, right? But preferred stock dividend, if you miss one period, that accumulates, right? So next period, you have to pay the dividend for 2 periods, the last period and this period, okay? And before you pay any common stock dividend, you must pay all the accumulated preferred stock first, okay? So the last point, the dividends cannot be paid on common stock unless all the accumulated preferred dividends have been paid, okay? So it is an obligation, just like debt, just like bond, okay? So calculation is also just like bond or perpetual bond, okay? So the present value of preferred stock is simply the dividend. Again, this dividend amount is fixed, right? Just like coupon payment, right? So dividend divided by the interest rate or discount rate, okay? So that's it. That's it for this chapter. Any question?